Good morning, everyone. Welcome to our Wednesday morning trading room. My name is Eric Senft. I'm going to be your host here for this morning's session. Just a moment while I get the screen share going on. For those of you who are new to the trading room, welcome. What you're looking at here is the diversified trading system, and I'm going to give you a really quick overview. It looks a little maybe overwhelming at first, but really it's not. It's really quite simple to follow. What you're looking at here, I've got two sets of charts. The charts on the left are the NASDAQ. The charts on the right are crude oil. On my other monitor, I'm also following soybeans and the mini Dow, but please feel free to ask for any market that you'd like to see. If there's a market that you're interested in, I'll certainly focus on it for you if I can. The charts across the top here are the Hawk microscalper. This tool has been specifically designed to pick up scalp signals. The charts through the middle are the Falcon Swing Trader. The charts across the bottom are the Eagle Trend Trader. Regardless of the tool, the signals all develop the same way. Namely, when a signal is starting to print, you're going to get a warning dot. We're actually getting a signal right here. A warning dot along with an audio alert that tells us that some of the signal parameters are being met and it's time, the system is drawing your attention to this particular setup. When all the signal parameters are met, you get a triangle and a hash mark. Now it's decision time. Now, not all these signals are created equal, and I'll point out some of these things as we go along this morning. But for instance, here on the Hawk microscalper, for the most part, we tend to avoid yellow bar signals. Now, even though this signal worked out, there's a lot of yellow bar signals that fail. See, that one did not have a whole lot of follow through to it. All right. So that's what we're going to look for. We're going to look for high probability setups, and we're going to use our trade manager here to contain our risk. The trade manager is this tool here on the right, and it allows us to cap our risk so that regardless of where we place our stop, whether we place a tight stop, note the risk amount, or whether we place a loose stop, okay, a little bit of a rounding error, but you see it's still trying to contain that risk to 2% of my trading capital. In fact, I could probably run that stop a little bit deeper still. Yeah, there you go. So what changes is your quantity. Your position size never really changes. Now I'm missing a couple signals here going over this morning. We got the trend change signal here on the Falcon right out of the gate, right off the open, and even the secondary trend line touch signal that we got here, just about to hit its high probability profit target. So a couple opportunities early on, and the market definitely looking a little brisker, if that's a word. Brisker. Johann's asking for the DAX. All right, hold on one second. I've got to add the DAX to my data feed. I thought I had it on there. 1 second. All right, so we'll just let the DAX load up, and bullish start to the day, isn't it? Let's take a look here at where we've been through the overnight. Wow, what a chop fest. This is on the Eagle Trend Trader. And as you can see, we didn't really get any trend signals. The market very, very sideways. And of course, now we're at the top end of this trading range. So I think we're going to hold off a little bit. Although the trade forecaster, this is this little tool that you see here in the top left corner. This is what we call a system add-on, or you can think of it as a standalone indicator. In other words, it will work with any chart. It's not part of the DTS package. You can put this on a 5-minute chart if you want, or 500 tick chart, or whatever it is that your preference happens to be. And it says that we're going to be in trend mode for about 2 hours. Well, that would be interesting. Yesterday, a little bit better, still quite a few swings. This was toward the close. And then, of course, we had the big decline out of the open, or shortly after the open, with this green bar sell signal. That's one of our high probabilities. Here on the Eagle, we always focus on the hard edge of this trading band. No, this is not an Ichimoku cloud. Yes, I know it looks like one, but it's not. The programming is entirely different. But whenever the market encounters the hard edge, in a similar fashion to the Ichimoku cloud, you expect resistance. So the market trades up into the trading band, encounters the hard edge, it produces a green bar sell signal. This is one of our high probability signals on the Eagle, and then you get a fairly decent progression lower. But where we're at right now, no, it's a total chop fest. We are getting reactions. The market moved into the band, produced a red bar buy, which is the opposite signal. There's a little bit of a move higher there, but not trending just yet. Okay, Permi, I'm going to get to your question in just a moment. Johan asked to see the DAX, so let's bring over the DAX here. So here's the Hawk scalper on the DAX. And a very nice first micro-macro cross signal. This, again, is one of our high probability signals that we tend to focus on. This signal here, when the micro line, that's the thin one, crosses the macro line, and it's the first signal where everything is in sync. So we have red bars, red trend lines, red filter. Very, very high probability signal, like to the tune that whenever I see this signal, I take it almost without exception. So there's the first micro-macro cross. Good follow through from there. Let's kind of roll through here's a first micro-macro cross higher, but it never triggered. Here's a first micro-macro cross followed by a macro pullback. The macro pullback just slightly different in that the micro line, that's that thin one, goes out of sync. So that's how you can identify that. Everything else stays in sync. The micro line goes out of sync, you produce a signal. That's a macro pullback. That was followed by a 4-arrow consolidation, which is again a high probability setup that we look for. 1, 2, 3, 4th signal right here. Now I know I said we avoid yellow bars, but the 4-arrow consolidation is an exception because it's such a strong setup. So within the span of about an hour, you had 3 really solid scalp signals. Another nice little first micro-macro cross. Here's a red bar buy that you could have sold to failure if you wanted in early. Another really good first micro macro cross signal. So lots of opportunities to scalp and even leave a runner in play. Huge follow through on the Hawk Scalper last night with the DAX. Let's take a quick look here at the Falcon now. So here's the Falcon swing trader. And let's take a look. Oh, here we go. So with the Falcon, what we tend to do is we tend to focus on the trend line. This trend line gives us our directional bias. So when the trend line's red, we're looking for sell signals. When it's green, we're looking for buy signals. Well, the trend change signal, this one right here, I know it's hard to see. I'll explain these lines here in a second. Trend change signal occurs when the trend line changes color. And the trend change signal is essentially that very first signal where everything is in sync. So that's right there. The hash mark is printing right on that line, so it's a little difficult to see. But we've got green bars, green signal, green trend line, green filter. That's a very strong buy signal. There came another, the market waffled a little bit through here, but you got another trend change signal right here, enough for a little scalp, or pardon me, a scalp, a little short, little swing. Very nice trend change signal right down here. If you missed that one, you had a second chance at it right here off of the trend line touch. Great follow through on that swing. Nice little bounce off of the primary support line. These lines that you see on here, this is another one of these system add-ons, or a standalone indicator, if you will. The, pardon me, these lines are part of the ultimate support and resistance suite. It's an assortment of 21 support and resistance lines, which are forecast for today's trading. They're not pivot points. They're not Fibonacci levels. They are much better. And we've got the three main lines here through the middle. We've got the median line, the primary support, and the primary resistance. These kind of set the tone for the day, and you can see the DAX is honoring them pretty well. Once the market gets above or below, it tends to have some follow through one way or the other. But right now, the DAX pretty content to trade between the primary resistance, the median line, and the primary support. So if we're bouncing, or an early bounce off the primary support, we may well see the market drift back up here to the median line. All right, so that's the Falcon. And just really quick, because I know you guys want to see some signals as well, here's the Eagle on the DAX. A very good rule of three signal here. This is a counter trend signal on the Eagle. And don't worry if you don't understand what these signals are that I'm pointing out, but they are pretty straightforward. When we have a bullish trend and we see the Eagle start to produce counter trend signals, so we're producing sell signals against a bullish band, that third signal is what we call a rule of three. It's a counter trend signal. It highlights the possibility that the market may actually head lower. So very nice move lower here on the Eagle off of the DAX. And let's see, do we get any other solid signals? It's a little choppy through here. So this is, again, why we have different tools. Because the market is not always trending, as I'm sure you're fully aware. It's not always swinging. It does scalp most times, and most times it makes itself available for a scalp. Okay, Permi's asking, what's the micro-macro cross signal? That's here on the Hawk Scalper. We're looking at one here to the short side, actually. So the micro line, that's the thin one, crosses over the macro line, that's the thick one, and it's the first signal where everything is in sync. So you see we've got, everything is red. Now the bars are moving into yellow bars, so I'm going to clear the signal, because yellow bars on the Hawk are very neutral. In fact, you see them all printing here, more or less the same latitude. We may end up being a little sideways-ish. We'll have to see. We'll have to see about that. Permi's also asking about, hold on a second here, I'm trying to multitask. I don't multitask well. Okay, Permi's also asking regarding the crude rollover, where can I find this information? 1 second. If you don't have a website that you reference for that kind of stuff, the best thing to do is to go to the source. That's what I find. You can always ask your broker too. All right. So, for rollover information, I tend to go to the cmegroup.com, and from there you can search your commodity of choice. I searched crude oil, and you can click on your contract specs, or there's also the calendar option. But in the contract specs, it will tell you termination of trading. I know it's a little bit confusing, but really it's not. You can also follow the volume on the charts. So essentially, crude oil terminates the third week of the month before the contract month. Does that make sense? So if you're looking at October crude, it's going to expire the third week of September. That's what we're looking at here, October crude. September crude expires the third week of August. November crude expires the third week of November, and so on. Or, pardon me, October. Always the month before. Good morning, Jim. Jim asks, or lets me know the advanced decline numbers today. We got about 1,200 on the buy, 1,400 on the sell. So we're kind of neutral, a little bit neutral at the moment between the buyers and sellers. Permi, you got great questions here today. Permi's asking, how do you decide if a market is choppy? I get this question all the time. And your tools will tell you if it's choppy. So for instance, here on the Hawk, when you see a lot of yellow bars printing, and they're more or less at the same latitude, that tells me that the market may be entering a choppy phase. Now, when you suspect the market is choppy, the best thing to do is to highlight that choppiness, allow the market to break out, and then look for it to retest and then produce a signal. So this is where we're at right now, and this signal is going to run away on me if I don't hurry. So let me set that up. Darn it, it did just break. Let me try to get it again. All right. Now I'm going to delete my profit target and break even trigger just so I can show you some of the features here on the Trade Manager. Now notice when I set up my trade, I didn't have to pay a whole lot of attention to where I placed my stop. I was focusing more on the fundamentals of it. I wanted to place my stop above a swing point because there is a chance the market may try to come here and retest this a little bit higher, right? They may tick up here a little bit. They may try to do some of this before there's a reaction. So I don't want to keep my stop here. I don't want to keep my stop down here because I'm going to get stopped out too early, right? I want to give the trade a decent chance to get to its profit objective. And the only way to do that is to keep it a little bit further away, to play the probabilities. Now, I know somebody's going to ask me about risk-reward ratios here in a moment, but essentially, I'm not a huge fan of risk-reward ratios because you're basing the entire trade, no trade decision on the reward side of the equation, and that's the part that you have no control over. You only have control over the risk. So the Trade Manager caps my risk at an amount that's affordable. Now, the part of the Trade Manager I haven't been able to show you yet, which I'm hoping I can point out here, is the profit manager, what we call the profit manager component. These are 16 different stop strategies that you can choose from to manage your trade, and they're all fully customizable. So let's say I'm going to go with the ATR. I'm going to leave this back a little bit. I can preview it, and I can see, oh, that's what it looks like. Okay, I'll accept that. And watch what happens when I click Enable. Actually, I'm going to roll this back a little bit more. I click Enable. I click Accept. Now the Trade Manager grabs my stop, and it will manage it through completion according to the stop strategy that I've selected. So hopefully we'll see it tick down here a little bit. You'll actually see the Trade Manager start to roll my stops automatically. Come on down. Let's go. Let's go. Come on. All right. Well, we're going to hold this back a little bit further. Oops, that's not what I want. Oops, they just ticked up there. I should have previewed my stop before I did that. All right, let's try that again. So that was pretty much a break-even, well, small little loss on that one. So what we're getting now is a macro pullback. The market's struggling a little bit here. This may be the bottom end of a larger trading range, is it? Where's the overnight? No, not yet. If they swing here, though, that's definitely going to see the buyers try to press the market up. And we did get a rally here out of the open, so we're heading into some support zone, no question about that. Where are we on our support and resistance suite? No, we still took a little bounce off the median line here. We could see the market slip down here to 47.20. Crude oil just kind of slipping lower through the overnight. A very nice trend change signal here. My goodness, that's textbook. The market drifts down, gives a little trend line touch signal just prior to the North American Open, and price is still sliding on crude oil. All right, one more chance here. Now we've got a green bar sell. This market's getting a lot more bullish, but I'm just trying to demonstrate the trade manager here for you. I think we're going to see a little bit of a rally, so don't follow me in on this trade. Oh, and now it's signals negated. All right, well, I will show you how it rolls your stops sometime today. Oh, Tony says we got a nice little trend change signal on the NASDAQ. Let's take a look here. Yeah, this is kind of an early trend change signal. Good eye on that one, Tony. Now, the early trend change signal, you get that little up, down, up pattern developing just before the trend line actually flips over. It's a little bit more aggressive. Here out of the open, got a very good trend change signal. All right, let's put that away for now. All right, well, they're still in limbo. Pardon me. And the buyer's really pressing. We're back here at the top end of this range, of course. And now they're going to try to swing lower again. All right, what's going on in soybean market this morning? Oh dear, nothing. Here's soybeans on the Eagle. And you can see very decent decline. Nice thing about soybeans, if you're looking for another market to round out your portfolio, it's worth your while to consider soybeans. They're not active all year, but they're certainly active for about 6 months out of the year. The great thing about soybeans is that once they settle on a direction, that's it. They just keep going. So this was a little odd. We don't usually see the overnight quite this strong, but there was a decent trend change signal here through the overnight. North American Open right around here, got a nice sell signal. Market tailed off a little bit. This was yesterday, by the way. And it's continued sideways since then. Now, Trade Forecaster says we're in scalp mode for about another 20 minutes, and then we're moving into trend mode, so we may anticipate a breakout. But scalp mode, yeah, I would say so. It's just dead sideways. In fact, there isn't even enough in there for a scalp. Nick's asking which months are the most active for soybeans. See, and Permi was asking before about how can you tell when you're in chop? This is how you can tell. Lots of yellow bars, lots of range, no follow through. Your filter looks like a checkerboard. So there's not even enough room in here that you can scalp out. So the market just to avoid for a little while until we see a breakout. The growing months, Nick, are the most active months for soybeans. So essentially the summer. The spring and summer, of course. The fall now is harvest. And that will also influence the soybean market considerably. The quiet months are the winter months. About the only thing that soybeans really react to during the winter, although they're grown a lot in South America now as well. In fact, the Brazilian crop rivals the North American crop. But as far as most soybean fluctuations during the winter months, a lot of times they're transportation issues, weather issues, stuff like that. Oh, Permy says, how can you tell in advance? Well, you can see the market starting to move sideways. For instance, here on the hawk. Yellow bars happen when the market transitions, right? So we see yellow bar, we expect a transition, we expect a first micro macro cross lower. This signal developed very, very late. Normally it produces a little bit earlier, but for whatever reason the conditions weren't right. It still had some decent follow through. Okay, so now we're producing yellow bars. Again, we're anticipating a transition. Here's a green bar sell, so we might expect a little bit, kind of a last ditch effort to move the market lower, but things are becoming more bullish. And now we're seeing more yellow bars. And at this point, I would be thinking, all right, are we going to get a transition or are we going to enter a sideways range? Now we're getting a macro pullback signal that would be worth attempting. So you could probably set up your trade something like that. Even if we are moving sideways, we can anticipate a test of the top end of the range. So here we could take profit before we get to the top end. So we got our profit on that little scalp. And some follow through. So now I'm thinking, okay, the market is probably going to trend, even though we're at the top end of some resistance again. Now we're holding up, and now we're yellow bars again. All right, so yellow bars, we anticipate a change in direction, change in trend. So here's a first micro macro cross lower. You probably set it up something like this. And it's like, oh, more yellow bars. What's up with that? So when you see these yellow bars starting to crop up and you're not getting the follow through, see here's more yellow bars. Now I'm thinking, okay, possible sideways range again. All right, so that's how you can tell when you're potentially entering a choppy zone. You get all these yellow bars, you get a lack of follow through. And you just watch and see how the market responds to that. Lee is asking, do you trade the oil report? Yeah, that's going to be out in about 20 minutes time, isn't it? 25 minutes. Yes, a lot of times what I tend to do is if there's a discernible sideways range, and let me point out here soybeans because soybeans will be a perfect example. And in fact, you can do this with soybeans right now if you like. I bracket the range. So the trade manager has this OCO function, one cancels other. So you can place your order on the chart. These orders are live the moment you put them on, so I tend to place them away and then pull them in to where I want them to be. But that looks pretty good. We'll give it a couple of ticks to break out. And I'll activate a stop. Let's see, where would that one be? Smooth it out a little bit. Yeah, that'll work. Okay. So this is how I would normally do crude oil. I would like to see the market in a sideways range with the prices trading somewhere near the middle. And then I'll bracket the range. This morning's crude is not as cooperative as the market seems to be in a little bit of a downtrend, or a little bit of a downtrend, a considerable downtrend. And the range is much larger. You could say this just prior to this morning's open is the top end of the range and here's the bottom end. If they start to move a little bit sideways here for the next 20 minutes and it gives me something I can bracket, I will bracket the range. Otherwise, I may take a falcon signal if one produces. And other than that, I may let the crude inventory report hit the floor, let the market react to it, and then place my order, my bracket order. All right, so we're getting a, shoot, we had a trend change signal right here. I'm a little bit late on this one again. We're right on the primary resistance, and we're producing a double dot. All right, I'm going to just take the signal here so, again, I can show you how the Trade Manager tool works. So we're going to set it up like this. Okay, I'm going to delete my break even and my profit target. And hopefully this time I'll be able to show you how the Trade Manager rolls your stops. There we go. So if we see the market tick up a little bit there. All right, so there we go. Let's see if it ticks a little higher. Great question here from Bo. Bo asks, which of the NASDAQ And the E-mini is ideal for the beginning day trader, and why? Great question. You know, a lot of people never consider their market mix and how it affects their profitability, and yet it's a huge determinant. People trade something because they think it's cool or it's sexy or they're interested in it. I see traders all the time leaning toward crude oil and the E-mini because those are two of the world's most popular markets. They're big tick markets, and you know there's huge potential. They're very exciting markets. You know, crude oil will make $1,000 a day range. So people look at that and say, "Wow, $1,000! I can make $1,000 a day." Yes, you can. Problem with trading a market like that is you may not be able to afford it. So it all boils down to your account size, really. Now, hopefully, you've noticed there that the trade manager has been rolling my stops up a little bit here automatically while I'm going on about this. I prefer the smaller tick value markets. The reason is it's going to allow you to A, run a deeper stop, which will B, increase your probabilities of a winning trade. Oh, we just got filled here on the short side on the soybean trade, and notice that the buy order disappeared on the OCO, and we've got an automatic stop trailing. I'll leave the break-even trigger in on this one, but there's our soybean trade underway. And did I already mention C, that you'll be able to trade multiple contracts? Now, multiple contracts are great because it gives you management options. Most times, I'm all in, all out on a trade, right? A lot of times, we would have just hit our profit target. I'll just take the profit and be done with. But here's the problem. If you're trading a single contract, what do I do with this trade now? I have got about $100 in open profit. Do I take the $100? Do I try to run it out for more? Well, it's a tough call. The E-mini trades at $12.50 a tick. The NASDAQ trades at $5. So you can essentially trade 2 NASDAQ contracts for each E-mini contract. And depending on how the trade's set up, sometimes you can even trade 3 contracts. So that gives you options. If I were trading, you know, if I set my stop a little closer, or if perhaps I took the signal on the hawk where the setup parameters were a little bit tighter, let's say 1, 2, 3, 4, here's a 4-arrow consolidation. I take the signal, I risk it here to the macro line. You can see I've got 2 contracts in play. That gives me options, right? I can take partial profit on one. I can try to let the other one run out. But if you're always just trading a single contract, that makes for some pretty tough decisions all the time. All right, I'm just going to let this play out. Like I said, normally we would have hit our break even and our profit target. Oh, by the way, I can force the trade to break even anytime I want by this button here. So we've got the break even. Right now it's set at break even +1, but I can set, you know, break even +5 ticks if I want. So I'm a big believer, like I said, in the lower tick value markets. What a lot of people don't realize is that if they think that they're making more money trading a higher tick value market, right? Because they think, okay, well, if the E-mini moves 10 ticks at 12.50 a tick, that's $125. The Nasdaq's only $5 a tick. Therefore, that's only $50. I'm making twice as much money trading the E-mini. And on the surface, that seems to make sense. The problem is the markets don't tend to move an equal number of ticks. In other words, if the E-mini moves 10 ticks, that does not mean the Nasdaq moves 10 ticks. However, they do tend to move more or less an equal dollar amount, which means if the E-mini moves $100, then the Nasdaq will also move approximately $100. So if you're comparing dollar for dollar, then, and you're able to trade 2 contracts or sometimes 3 in the Nasdaq, well, you have the potential to actually earn more money trading a smaller tick value market. And if you're trading a small account, these big value markets like crude oil and the E-mini make it very difficult to cover a position as well. So for instance, let's say we decided to take this signal off the North American Open. So there's a sell signal. Where do I cover this? Well, I know the tool has a lot of momentum behind it. We usually get very good momentum signals. So it's so tempting to put the stops right here. But what if it looks back a little bit? Do I want to get tagged just because the market backed up 1 or 2 ticks? No, probably not. So where do I place my stop? Well, how about I put my stop up here above the last swing high? Oh, no. Trade manager says, sorry, Eric. For your account, you can't afford to trade that, not at 2%. Now I can dial up the risk. Let's say I want to risk 4% of my capital. Generally speaking, anything less than 5% is considered prudent. All right, well, trade manager says, okay, if you're prepared to risk 4% of your capital, you can take that trade. Now, for me personally, I have a 5% drawdown. That's my max on the day. So if I get stopped out on this trade for the full amount, my day's pretty much done. So it's like a one and done. You walk up to the roulette wheel, you throw everything on red or black, and hopefully it comes up. Otherwise, you walk away. And I do know people who gamble that way. All right, we're getting a little bit closer to the inventory report. No, nothing yet. What I'll do is I'll bracket it to show you the OCO function. And I'll let you know when something more promising develops. In the meantime, Tony asks, Eric, a nuts and bolts question, how do I handle the brightness of the entry, reward, and risk lines? I've looked around, don't see where to do this. Okay. Go here to your strategies window. Click on your trade manager. Remember to turn it off so you can make changes. And you need to apply. And then if you roll up here, you're going to see your displays. 255 is as solid as you can make it. Right now, a lot of the entries are set at 100, so it's about half the brightness or half the opacity. So if you dial it up to 200 or 255, that will make it a little bit more pronounced. Then when everything is to your liking, go back here to your enabled tab and turn everything back on. And that should help. Good question. Bo asks, is there high-frequency traders interference in the E-mini? Yes, but it's in all the markets now. And to worry about the HFT traders that much because they're in and out for micro scalps, right? They're trading 10 times a minute if they can. And when the computers are doing it, they could be trading 100 times a minute. Every time you see the bar tick up or down, that's high frequency traders taking their little slice of the pie. We're more, obviously we can't trade that way. We're more interested in the directionality of the market. This is where the mean wrinkle bars that come standard with DTS are very helpful because you can see very plainly when the market is changing direction. See, we're in an uptrend, the market comes down, tries to resume the uptrend, fails, market moves lower, tries to go up, tries to come down, comes back, produces a signal, market goes higher. See here, when we had the failure, there was a very good chance that if we'd already changed the trend line color, there was a very good chance that if we came back here now with the red bars and the sell signal, that would have been a good sell signal and we could anticipate the market to head lower. Oh, but got spoiled here by the green line. Now we get a trend change signal to the upside. And we're getting some pretty decent follow through on that. So you see the trade manager rolling my stops. What do we have in open profit? $200. All right, well, maybe I will go to a more aggressive stop strategy now. So I'll change to the parabolic mode. It will follow the market a little bit more closely. There's also the bar high-low strategy, which is more aggressive still. Lots of options. The DTS system itself, though, has been designed to be as easy to use as possible. So when the signals print, you look at it, you determine whether it's a high probability signal, you determine where your entry and stop losses should go. The risk manager component of the trade manager caps your risk. Here's a nice little 4-arrow consolidation, by the way. So the trade manager caps your risk so that you don't need to worry about overextending yourself. See, what most traders do wrong is they risk far more than they can afford on a trade. They maximize their winners and they minimize their losers. That's what the trade manager does. Sorry, most traders do the opposite. They maximize their losers and minimize their winners, which of course is the opposite of what you should be doing. Looks like the trade forecaster was right. Once the market settled on a direction, it said we were going to be in trend mode for about 2 hours. We did get a red bar buy signal down here, a little bit iffy to take on the eagle, but as you see, we did get subsequent signals on the falcon and certainly on the hawk. But yeah, we're in full-on trend mode this morning. So I'm glad I allowed this one to run out a little bit. All right, about 4 or 5 minutes to crude inventory report. Let's see what we got here for ranges. Maybe we'll try it on the hawk today. The ranges are a little bit tighter. Now, when the range is this tight, bracketing this range is very dangerous because if you follow crude oil at all, you know it's nothing for it to slip 20 or 30 ticks one way and then reverse and go the other way. That's why I'd like to see a more pronounced range. What I would recommend for this morning's crude oil is that you actually allow the inventory report to release, and after that you'll see in about 30 seconds to a minute after it releases, you'll see a range, and then you can bracket that range. But hey, it's a demo room, so let's demo. And what we'll do is I'll use the OCO function and I will enter above that little swing high, and I will short below that swing low. And I've got my stops activated, running a fairly aggressive stop here. Yeah, stops are on. Okay, good. So in about 2 minutes, 3 minutes time, we'll see the crude inventory release, and that should liven up the market a little bit. I didn't feature this tool this morning, the Geiger counter. This is another one of these system add-on type tools, the Geiger counter. Essentially a tape reader, gives you a visual of the time and sales. So we'll see the tape print here in a moment. And then what's interesting about the Geiger counter is this wheel around the outside. When we see the wheel pull one way or the other, all right, Russell, I'll get to your question right after we watch the inventory release here on crude. So the buyers digging in there a little bit. I'd like to see this wheel pull and hold one way or the other. That kind of shows us buying and selling pressure. All right, about a moment before the release, there we go. I'm going to delete the break even. Oop, no, didn't get to it. All right, let's try that again. So we kind of know the top end of the range is right up there. The bottom end of the range appears to be down here. Oh, there they go. There they go. That's more like it. Whoa, that was a crazy release. My goodness. Here, let's take a look at this on one of the other tools. It'll be a little bit more focused. So this is what we were looking at. The market came, set up a little bit of a range, and then we bracketed that range about 10-20 seconds after the inventory release. Huge move lower. And you could re-bracket it as well if you wanted. You could have thrown in another buy order here, or perhaps even here. Although that unfolded a little bit quickly. So probably above here and below here, you could re-bracket it. Look at that, came down, nailed the support zone, the secondary support, almost to the number. I suppose what I could have done, along with bracketing as well, is I could have set a profit target down there. That would have been pretty cool. Lots of options, loads of options. Okay, so we'll put that on the shelf for now. Oh, and it looks like we got tagged on the trailing stop right here. So you see the beauty of the trade manager? I didn't even have to manage this trade. I could look around, I could take a crude oil trade, and the trade manager took care of this one for me. So that was a wild ride. Okay, Russell's asking, when you get a moment, can you check the difference between the September and the December YM and explain the enormous difference? And I will do that for you, Russell. 1 second, I've got to reload my September Dow. Okay, so when you're looking to compare contract months, an easy way to do it is to pull up this tool here called the Market Analyzer. When you do that, you're going to get this window here. To populate the Market Analyzer, just right-click and add your instrument from your list. So I'm going to add the September Dow, and I'm going to add the, December Mini Dow. Now when you right-click on here, we're going to adjust the columns because I don't really care about the bid and ask. So we'll remove that, and we're going to look here for daily volume. Okay, so we've got the last price. You can see there's quite a discrepancy price-wise. The December Mini Dow trading considerably lower than the September. But what's more interesting here is the volume. The volume is 4 times as much in the December contract as it is in the September contract. Now September is still, there's lots of liquidity there. You've got almost 20,000 contracts being traded today. But the difference is because the September contract is going to expire in a couple of days. It expires by the end of the week. So that's why we've got so much more volume and price activity going on in the December contracts. So if you're still trading September, you're safe. Don't panic. You don't need to flip over, but maybe tomorrow or at the end of today, you'll want to roll over into December. Now you can do the same thing. We were talking about crude oil a little bit earlier. How do you know when it's time to move into crude oil, another crude oil market? Well, here is October crude, and crude oil is a little bit of a different animal. You're going to see here that it's not going to make that much difference. Let's move that one there. Okay, so we've got October crude. We're going to add November crude, and we're going to add December crude. Now, crude oil is one of the world's largest markets. You can see here in October, it's the most active month at 277,000 contracts. But even if you were trading November, you're still trading nearly 120,000 contracts. That's huge. even if you're trading December crude, it's still enormous at 40,000 contracts. What you will notice, though, is that the front month is always the more active one. If you watch the price changes, you'll see normally the front month make more volatile or have a little bit more volatility to it. The price swings will be a little bit greater than the further out. And that should make sense intuitively, right? You're in the future, by December, you're not so worried what the price of crude is going to be, right? December's still a long ways off. So, you know, a couple cents here, a couple cents there, that's not so much. But what's crude oil going to be worth at the end of next week? That one's a little tougher to call. So you're going to see more volatility in the front month. But yeah, when you start to see the volume of the further out contract month overtake the near month or the front month, then it's time to flip over. Yeah, of course. Russell's saying, can I see your YM, December YM Hawk chart? There you go. Very steady day in the YM. The mini Dow really good that way because it tends to trend quite well. Not quite as volatile as the NASDAQ, or in terms of price swings. Not usually, anyway. So a nice first micro-macro cross shortly after the open, and they never looked back. All right, a pretty decent day for the most part, though. All right, so are they getting a little toppy here, perhaps? Market's definitely in an uptrend, though. It's so tempting to short an uptrending market, isn't it? But because you know somewhere along the way it's going to reverse. You can't help but look at this and think, oh my goodness, this market has got to be so overbought. All right, we're going to get a red bar buy signal here, which actually gives us the opportunity to short this market. The red bar buy and the green bar sell both are counter trend signals on the Hawk scalper. Oh, come on, print the signal. Let's go. Right now we just have the warning dot, so there's no signal there. Just yet. Possible trend change in crude oil already? After that massive rally? Possible trend change working here on the Falcon as well? The Eagle's still very bullish. So we're getting a couple different scenarios printing. Just waiting for something to develop here. We're in between signals right now. Everybody's gotten quiet. All right, I wouldn't be overly aggressive on this, but we are getting a first micro-macro cross lower here in crude and a trend change signal here on the Falcon in crude oil. You would probably want to take it below the recent lows. Could cover it up there. But again, this market very much in an uptrend. If the signal prints and it fails, somebody's going to email me today and say, Eric, why did that signal fail? Well, you have to take the context of the chart into consideration as well. Yes, it is a high probability signal. Oh, it's not done yet. Still getting a warning dot. There's the signal. Oops, come back here. Oh, shoot. Are you going to give me another chance? Oh, you stinkers. What I was going to say is, yes, it's a high probability signal, and yes, you should take it, providing you can contain your risk. It always boils down to the risk. If you can afford the trade, and it's a high probability signal, then by all means take it. Tony's asking about a late filter entry on the Falcon. I'm assuming the NASDAQ. Yeah, okay, so Tony's looking at this and asking, why did the late filter entry signal... Now, the late filter entry signal is when the filter goes out of sync, comes back into sync. Trend line never changes color. Very important. And we produce a buy signal. Tony says, why did the signal fail? Well, has it failed? If you put your stop right here, then yeah, it probably has failed already. But when you're looking at a chart like this, there's very little structure down here. And whenever you get these runaway markets, it's really, really tough to trade because you want to know where the stop should be. Yeah, way down there. But trade manager says, oh, Eric, you can't afford that. That's a little too rich for you. All right, well, what if I go below this zone down here, that little swing? Oh, still can't afford it. See, there's nothing to base your trade on. This stop is a little bit tight. Why? Well, because if the market flounders, this is going to be the very first place the sellers are going to violate. And they may violate it by a little, they may violate it by a lot, but this is easy pickings for the bears, right? So you don't want to put your stop there. I guess there was a fair amount of volume on these two bars down here. You can tell by the width of the bars. So maybe that's an adequate place to put the stop. Your initial stop placement should always be far enough away. Think of it as your safety net. You need to be comfortable with this amount. This is 2% of my capital. Yes, a $300 loss would be unpleasant. But if I place my stop really, really tight, it's going to be a $300 loss anyway. So why would I, if my risk amount does not change, why would I not give myself a little bit more staying power? So here the market comes up. I bet you it just kissed the break-even trigger, came up short, and now we're floundering a little bit. So what I would like to see is I would like to see the buyers show up one more time. How do I know the buyers are likely to show up one more time? Well, this did not happen by accident. right? There was a whole lot of buying pressure down here. We rallied the market almost for a whole half hour. Now we're seeing the sellers try to push the market down. Are the buyers going to walk away from that? No. They will push one more time. This is how we get our tests of the extreme and the failures and the eventual reversal. But now I'm on the lookout for this part here. When I see that part, when I see the buyers come back into the market, then I'll know I can start to adjust my stop. So while my stop may initially be near $400, I can roll my stop up once the buyers show up. They may not show up until down here, but when they do, then I can start to roll my stop along with the buying. If you do that, you'll be amazed how many times you can turn a potential losing trade into a winner just by keeping your stop loss out of harm's way. Again, think of it more of as a safety net. This is your parachute. If the bottom falls out of the market, you're going to take a $400 hit and you're going to say, whew, that was lucky. Because the bottom fell out of the market, all I lost was $400. But the chance that I'm going to take a full stop out here is pretty slim. It's not that it's, it doesn't have the potential to make a full reversal and tag me out for the full amount. But even if it does, I can take comfort in knowing I did not lose more than I can afford. So the other thing that's going on here, Tony, and I forget this myself. If the market has exhibited a strong trend during the day, at 10:30, 7:30 Pacific, is very often when we will see the market try to reverse against the dominant trend. So that's what we're running into now. So we got a late filter entry signal. It's printing at the bottom of the hour. Yeah, it's a high probability signal. Maybe, maybe I want to dial down the risk on it a little bit because it's, 10:30. I'm thinking, all right, what if there's a reversal? Okay, I can't frame it like that. What if I frame it like this? Nope, still can't do it. All right, maybe I just have to watch it go by. Right? That's the whole point of having the trade manager, is to keep you from doing something silly, like risking more than you can afford. All right, so the buyers tried to push once here. They'll normally let the market go against them twice. So that's move number one. Here's move number two. Once the buyers probably won't stand for a third push against them. So let's say our initial risk was like this. Okay, so now the buyers are pressing. I would love to see this bar finish on a bullish note. But even if it doesn't, I can bring my stop in right there. So the seller's pressing once, pressing twice. If it fails at this point, well, then it's likely to wander or perhaps even slip a little lower. I doubt very much we're going to see a full reversal after a day like this. What's more likely is that the market's going to start ranging a little sideways. Lorna is asking about the E-mini. Hold on a second, Lorna. I will load up the E-mini. Honestly, the E-mini and the NASDAQ will be very similar, but we'll just let it load up here for a moment. All right, the E-mini's almost ready. There we go. All right, so here's the E-mini on the Hawk. And you can see very similar to the NASDAQ. In fact, we actually got an extra signal here. We got the first micro-macro cross down here, great follow through. We got the red bar buy and the subsequent failure. So you could already be short the E-mini, and here's the first micro-macro cross lower now on the E-mini. And that just hit our high probability profit target here on the Hawk scalper. So I think the E-mini is going to be very similar. I don't think we're going to see a full-on reversal. However, sideways range, a definite possibility. Here's the Eagle Trend Trader. Out of the open, get the trend change signal, and again, the market never looked back. Got an early trend change signal here lower. I don't think I would have taken it though, because of the strong uptrend. And now we're getting a trend change signal right here. Can I cover it up there? Oh, I can too. So the E-mini, if I were short here, I would be doing the opposite now of what I was just showing you on the NASDAQ trade. I'd be looking for another push lower and an opportunity to start bringing those stops in a little bit more aggressively. And here's the E-mini now on the Eagle, and again showing a very similar pattern to what we saw on the NASDAQ. We've got an hour left in trend mode. And we're into the hard edge. So this is where we anticipate a reaction, right? We would anticipate the buyers showing up here, perhaps giving us a bullish reaction. Yeah, okay. Sorry, Permy. Permy's asking, what E-mini? I thought the NASDAQ, the YM, and the ES are all E-minis. Yes, they are. The E-mini is the nickname for the E-mini S&P. The YM is usually referred to as the mini Dow, and the NASDAQ is usually referred to as the NQ. So yeah, if I say the E-mini, by default I'm referring to the S&P, the ES. All right, so back to our example here. So here's the late filter entry signal. The market starts peeling against us. The buyers push. the sellers come back, the buyers push again, we roll up our stops, and it eventually reverses on us and stops us out. But here's the interesting thing. We didn't take the full stop out, did we? We ended up taking a hit, but it was only for half the amount. So we probably took like a $200 stop out here. But we didn't take the full stop out by placing our stops ultra tight. Right? Your risk amount always stays the same. Very important. If I had put my stop right down here, I actually would have lost more than by running a looser stop to start and then adjusting it after the second attempt to recover the market failed. Now look at this. If I left my stop alone, just left it here above the prime or below the primary resistance, this may well reverse and get back into a profitable position. I know of one trader who will take a look at the market and determine whether he wants to be long or short, and then he'll place a stop above or below the high of the day, depending, whether he's long or short. And then he'll leave it alone. So if we had done that today, so here's the open. Okay, so here's our first signal down here. Oops, sorry. Oh, by the way, you can preset up to 3 targets and a runner. You can preset your profit objectives here. You can also click your targets. So that's what I'm going to do here. So we enter here, we place our stop loss down there. He's still long on the day. Oh, he's pretty much up to break even at the moment. A little better than. But you see, that just gives you enormous staying power. And again, this would be an amount that he could afford. So $300, $350. The chances that the market's going to make a full reversal and trade through the low of the day, very, very remote. Not quite the way I do it, but it's an interesting concept all the same. All right, ladies and gents, the market seems to be getting a little bit quiet here. I think we might button things up. Unless anybody has another question, please type away. I will wait. Lee is asking, do the signals come with a PDF? Yes, definitely. We also have these, what we refer to as cheat sheets, which, where is it? There's one. So here's the Hawk cheat sheet to highlight the high probability signals on the Hawk. So these are the signals that we're going to focus on. First micro-macro cross, the macro pullback, 4-arrow consolidation, post-consolidation pattern, and then the red bar buy or the green bar sell. So you can see, really quite simple. These are the ones that have the highest probability of success. You can see there's other signals that are printing around here, but these are the ones that we focus on, those 5. And of course, there's a trading room, a daily trading room for DTS owners as well, where we go over all this sort of stuff. is asking regarding the cost of the systems. You can go to the indicatorwarehouse.com website, and I would also recommend that you email Adam at indicatorwarehouse.com, because if you're looking to bundle things together, you know, maybe you want to get the trade manager, the DTS, and the support and resistance lines. You know, Adam can bundle a price for you. Stephen, if you can email me your thoughts on the Wednesday room, that would be great, and we'll see if we can't fix things up. And make sure you CC Adam as well. So that's Eric at supportandresistance.com. If anybody has any questions afterwards, you can always email me. Permi, okay, good question here from Permi, and I think this is the last question that we have going. Permi asks, I don't see how one can trade your method as I don't see the high probability entry signals. Okay, it's a very short learning curve, Permi, and I know at first, if this is the first time you've seen it, sometimes it seems a little bit overwhelming. But let's look at the hawk, and let's just take the first micro-macro cross signal into account. So you're looking for the micro line to cross the macro line, and it's the first signal where everything is in sync. There's one right there. All right, first micro-macro cross signal, red filter, red bars, red signal, red trend lines. Here is another first micro-macro cross signal. Here is another first micro-macro cross signal. Where did this one print? Here's another first micro-macro cross signal. Here's another. All right, so it's really not that difficult to identify. Once you get a handle on that one, then you can add the macro pullback signal, which is, again, very simple to identify because everything stays in sync except the micro line. The micro line goes out of sync. So let's take a look now at macro pullback signals. And like I say, we go over this every day in the trading room for DTS owners. So there's a macro pullback signal. Here's a macro pullback signal. Here's a macro pullback signal. Note everything stays in sync except the micro line. Here's one that didn't trip. That one never triggered. Here's a macro pullback signal. Where is another one? Oh, here's one. This one gave you a little bit of heat. Again, all the more reason not to run your stops ultra tight. See, the market wasn't quite ready to rally yet. Gave you a little bit of heat and then took off higher. Right, here's another macro pullback. Here's one that never triggered. All right, so this is just on the hawk, right? The other signals are pretty simple to identify as well. You just have to know what the setup is and what to look for. Here we're getting a trend change, possible trend change now. So the trend line has changed color, so that alerts me to the possibility of a trend change. Yeah, like Tony writes, Permi, hang in there. It's a short learning curve, and you can make a living only trading the first micro-macro cross, which is true. That first micro-macro cross signal on the hawk, it's such a high probability signal. I take it almost without exception. Here's a warning dot. The signal's about to print. This is a very high probability setup. So I'm just waiting for the signal to complete. Russell, absolutely. Russell says, can I see your YM Hawk one more time? There's the mini Dow on the Hawk. And if I've missed your question, or if you have, something pop into your head after we close the room, you have my email. You can also email Adam. His information is on the website, indicatorwarehouse.com. Please don't be shy. And there we go. All right. All right, so we're going to button up the room for this morning. Okay, Permi, great question. Permi asks, what about the other tools? Do they have high probability signals? Yes, absolutely they do. Okay, so our Hawk signal failed, so we're going to close that. The first micro-macro cross never completed. All right, so here on the Falcon, here, let me get you the Falcon cheat sheet. It will make things a little easier, perhaps. Falcon, there we go. So these are the three high probability signals that we focus on in the Falcon. We have the trend change signal, which is essentially the first signal that comes in sync after the trend line changes color. We have the late filter entry signal, which means the filter goes out of sync, comes back into sync, but the trend line never changes color. Very important. Then we have your trend line touch signal. And the trend line touch signal is going to have like a bear or bull flag flavor to it. So let's take a look here now. This morning, trend change signal right here. Right? Trend line changes color. Essentially the first signal where everything is in sync. A little bit of a refinement on the trend change signal is it tends to have this type of pattern where you get the push that changes the trend line color, you get the counter move, showing you the sellers trying to recover the market, and then you get the buyers taking the market back from them. All right, so that's a trend change signal. No trend change to the downside. Here's a trend change to the upside again. This is an early trend change signal, but that's a little bit of a refinement. Here's a trend change signal higher. Here's another trend change signal. So whenever you see the trend line change color, I'm looking for that little bit of a pattern and for that signal to develop. Here's another trend change signal. I haven't really been getting any sell signals. Here's one. You took a little bit of heat on it, but it eventually got up to its profit objective. Again, all the more reason not to place your stops ultra tight. To the short side, we're getting all early trend change signals. Oh, here's a trend change signal. Okay, here's something you're not going to see in any other trading room. I'm actually going to show you a signal that did not work out. As good as the signals are, they are not 100%. So out of however many signals I showed you here, 5 or 6, here's one. The market went down, it failed, it reversed. You would have been stopped out on this one. All right, so there's a signal that did not work. Here is a trend change signal followed in short order by a late filter entry signal. Very, very high probability signal. Okay, just quickly, we're going to go over the eagle. I know we didn't focus on the eagle very much today because, well, we had better opportunities on the other tools. But here's the eagle trend trader. In fact, I should probably look at this on crude oil because I don't think The NASDAQ has been very trend-like the last little while. Okay, with the eagle, this band gives us our directionality. Whenever the market encounters the hard edge, we anticipate a reaction. All right, so here, let's go back here. This is a little bit better. So we've got a little bit of a downtrend. The market moves back, encounters the hard edge, and now we come out with what we call a green bar sell. So we've got green bars along with a sell signal. This is a high probability sell on the eagle. Here's the opposite of the green bar sell. This is a red bar buy. That's a high probability buy signal. Now, next to this, we also have what we call a rule of three. And I know this is a little bit confusing because I'm going over this rather quickly, but rest assured we go over this all the time. Excuse me. So we have the rule of three signal here on the eagle. We've got a bullish band, a market that's obviously in an uptrend, and now we start to produce sell signals below the bottom edge of the band. After the third signal, we normally anticipate the market to start moving the other direction, which is what happened in this case. A rule of three must always, always, always be preceded by a test of the high or low and a failure. Here we actually had two tests of the high and low and then the failure. So this would have been actually a very predictable rule of three to try to short. And you can see you would have got in very early and a nice progression lower. Permi asks, is there a cheat sheet for the eagle? No, not yet. The problem is I haven't found one screen segment that shows me all the conditions on one chart. Although this one's pretty close. Let's see if I can squeeze that green bar sell in there. Oh, almost. I may have to make the screen a little bit bigger. All right, thanks, Permi. I think I may have just found the screenshot I need for the eagle. But again, rest assured that regardless whether there's a cheat sheet or not, I'm always available via email, and we go over these things every single day in the trading room. So if you have questions, if you're confused about something, we'll go over it until you get it. Okay, Permi asks, I didn't look at the Russell for the Hawk. I saw that the Falcon was 8 ticks and the Eagle 12 ticks, so what's the reason for these differences? Before the DTS system was released, it was actually, we spent 9 months optimizing it. I remember 9 months because, of course, that's how long it takes for a baby to be born, so that's how long the DTS baby took to be born. The Hawk settings were set at 6 ticks, the Falcon at 8, the Eagle at 12. These were just the optimized settings for each particular market. These work for 99% of the markets that you're going to trade. Occasionally you will run into a market that doesn't meet or fit neatly into those parameters, the E-mini being one of them. And so for the E-mini S&P, we have the alternate settings, which is a 4-tick Hawk, a 4-tick Falcon, and a 6-tick Eagle. And the easy way to remember that is the telephone prefix in Moose Jaw, Saskatchewan. See, no, you'll never forget it. But yes, that's a lot of this came from very extensive testing. We had a whole beta group of traders trading the system before it was ever released and making the recommendations, and these are the values that we settled on. Now, that doesn't mean you can't change that. You know, if you'd rather have a 5-tick hawk or a 4, if you think that works better for you, then by all means. But yeah, these settings were all optimized via extensive testing. All right, I think I got everybody's question. All right. Well, thank you very much for your participation today and your attendance. I hope that it was halfways informative for you. DTS owners, we'll see you in the trading room again tomorrow morning. And yeah, we'll talk to you then. Bye for now.